Okay, so welcome back to chapter 1. We're on learning objective 4. So we're looking at wrapping up this by looking at 3 of the 4 financial statements. There's actually 4 financial statements. We're only really going to address 3 here. If you go on and take Accounting 2301, Principles of Financial Accounting, we'll talk about the 4th statement at that point in time. So the first statement, and I say the first statement because they have to be prepared in a certain order. So the first statement prepared is the income statement. You'll also hear this called the statement of profit and loss. So the income statement shows us our revenues, our expenses, and then whether we had profit or net income, or whether we had a loss or a net loss. So profit and net income mean the same thing. Now, really important that the income statement covers a period of time. Your income statement can be for however long you want it to, a month, a quarter, a year, but it always covers a period of time. So when we prepare any financial statement, all financial statements have a 3-line heading. The first line of the heading is the name of the company. The second line is the name of the statement. And the third line is the date or the period of time that the statement covers. So here we have our example income statement. Notice we start off with our 3-line heading, the name of our company, the name of our statement, and then the date. So this statement covers the month end, September 30th of whatever year. Notice also we use columns. Columns help us to organize and make the statement easier to read and understand. So the first column is for individual amounts. And then the second column is for the totals. So notice that we only had one kind of revenue. So that was total revenue. We went ahead and put that $5,000 in the total column. But if we had had 2 kinds of revenue, we would have listed them individually in the first column and then put the total in the second column. Just like we did with our expenses. So we can see our expenses are listed individually. Now, anytime we see a single line means subtotal. And then we put the total expenses in the second column. Now, I want to encourage you to do something. We know that we calculate net income by saying revenue minus expenses. In accounting, we indicate subtraction or negative by putting parentheses around something. You technically don't have to put the parentheses in the financial statement, but I want to encourage you to do that. I'm going to encourage you to do that because let me erase that. That's a little messy. I want to encourage you to do that because, number one, we tend to forget that we need to subtract if we don't have parentheses around here. And I've seen too many students make silly mistakes, especially on a test when you're a little bit nervous, and they don't put those parentheses, and then we tend to add revenue plus expenses instead of subtract revenue minus expenses to calculate net income. So again, we have our single line to subtotal, then we say revenue minus expenses gives us net income. Notice we double underline at the end. The double underlining is customary. It indicates that we are totaling this statement out, so to speak. Notice also the placement of the dollar signs. We don't put dollar signs all the way down. It makes it messy. So it's customary to either just put the dollar signs at the ending or put it at the beginning and the ending, but we definitely don't do it all the way down. So the second statement we're going to look at is the statement of owner's equity. If we're talking about a corporation, we may call this the statement of stockholders' equity or even the statement of retained earnings. So owner's equity is increased by 2 things, owner investment and net income, profitable operations. So if revenues exceed expenses, if we have net income, then that is increasing the owner's share. If we had a net loss, that would decrease the owner's portion of the company. The other thing that decreases owner's equity is owner withdrawals. So as an owner, you won't get paid like a salary per se, but if you wanted to withdraw some of your investment for personal use, that's called that withdrawal. So notice again, we have our statement, our 3-line heading. So we have a name of our company, the name of the statement, and the date. Notice that the date is the exact same date as the income statement. So the income statement covers a period of time. The statement of owner's equity covers the exact same period of time. So we start off this with our beginning capital, the capital on September 1 at the beginning of the period. We add to it net income, and then we subtract the withdrawals. So that net income number comes from the income statement. This withdrawals tells us how much money the owner withdrew. Now, again, I want to make one correction here. Or try to be simplistic in this point, the textbook author is using a minus sign, but traditionally we do not use a minus sign. We would put this in parentheses to indicate that we are subtracting that $100. So notice our net increase in capital is the net income minus the withdrawals. So we are increasing capital by $3,600. We have again our single line to subtotal. And then we calculate our new balance in our capital account, which is last month's balance plus the increase from this month. So here we see a slightly more complicated statement of owner's equity. Notice in this example we had additional owner investment. So we started off with our September 1 balance or beginning balance, then we added the additional owner investment. Then we had, in this example, notice we had a net loss. So we had a net loss and a withdrawal. So since those are two negatives added together, for example, two decreases to capital added together, we add those together, and then again, I'm going to put this in parentheses, we're going to subtract the total of those decreases to calculate our new capital balance. So now we get to the balance sheet. So I want to point out a few things. First of all, look at our heading. We still see the company name, we still see the name of the statement, but notice the date. The date of the balance sheet is for 1 day and 1 day only. It does not cover a period of time. And if you think about it, that makes sense, right? The balance sheet is what we call a financial snapshot. It lists our assets, what we own, our debt, what we owe, and then our capital at a given point in time. Now those balances change over the period of time. So we're just saying, hey, this is what it is on September 30th, specifically at close of business on September 30th. So we're going to get into more complicated balance sheets later on, but for right now, notice we've just listed our assets, our cash, our accounts receivable, and our computer equipment. We just put a single line to subtotal and we totaled those up. They totaled 10,300. Then on the other side of the equation, we have our liabilities, our accounts payable, and then we have our capital balance, which comes from the statement of owner's equity. So those two added together equal the total of the assets, so our balance sheet balances. So I like this statement or this table because it reminds us of what goes in what account. Notice that with the exception of capital, and specifically the ending balance of capital, all accounts appear on only one statement. All accounts will be on one statement and one statement only. Capital is the only account that's on two statements. It's on the statement of owner's equity and the balance sheet. And then we've talked about this as we've gone through, but remember we have to do the income statement first so that we can calculate net income to put into the statement of owner's equity. Then the statement of owner's equity has to be done second so that we can calculate the new ending balance in capital to put in the balance sheet.